So you've decided to start investing in the stock market. First of all, congrats, seriously. Most people never even take this step. But here's the problem. Beginners make the same mistakes over and over again, and those mistakes can quietly destroy your money without you even realizing it. Today, I'm breaking down the most common stock market mistakes beginners make and exactly how to avoid them, even if you're starting with very little money. Let's get into it. This is probably the biggest mistake beginners make. You might be thinking, I'll invest when the market crashes, or I'll start once I understand everything. Here's the truth. There is no perfect time to invest. The market is almost always at or near all-time highs. If you wait for the perfect moment, you'll likely stay on the sidelines forever. Meanwhile, inflation is slowly eating away at your savings. How to avoid it? Instead of timing the market, focus on time in the market. Start small, invest consistently, and let compound growth do the heavy lifting. Even investing a little now is better than waiting years to feel ready. Many beginners buy stocks the same way they buy clothes because it looks good or someone else likes it. You hear a friend say this stock is going to the moon, and you buy it without knowing what the company actually does. That's not investing, that's gambling. How to avoid it? Before buying any stock, ask yourself three simple questions. What does this company do? How does it make money? Do I believe it will still be strong in 5 to 10 years? You don't need to be an expert. Just basic understanding can protect you from bad decisions. Beginners often go all in on one stock because they think it is a sure thing. The problem: no stock is guaranteed. Even great companies can fail. If all your money is in one place and something goes wrong, your entire portfolio suffers. How to avoid it? This is where diversification comes in. Spread your money across multiple stocks, or even better, use index funds or ETFs. Diversification reduces risk and helps smooth out market ups and downs. The stock market messes with your emotions like nothing else. When prices go up, beginners feel greedy and buy more. When prices drop, fear kicks in and they panic sell. This usually leads to buying high and selling low, the opposite of what you want. How to avoid it? Have a plan before you invest. Decide why you're buying, how long you'll hold, what would make you sell. Stick to your plan, not your emotions. Remember, the market goes up and down, but long-term investors win by staying calm. Social media makes investing look easy. You see screenshots of massive gains and think, why isn't this happening to me? The truth is, stock investing is not a get-rich-quick scheme. Most successful investors built wealth slowly over many years. How to avoid it? Shift your mindset from fast money to long-term growth. Focus on consistency, not excitement. Boring investing often beats exciting investing. This is a sneaky mistake that beginners don't notice until it's too late. Trading fees, fund expense ratios, and taxes may seem small, but over time, they can eat away a huge portion of your returns. How to avoid it? Use low-cost brokers and low-fee index funds. Also, learn the basic tax rules in your country so you're not surprised later. Keeping more of your returns is just as important as making returns. Some beginners invest every dollar they have, leaving no cash for emergencies. Then when life happens, a medical bill, job loss, or unexpected expense, they're forced to sell investments at a bad time. How to avoid it? Before investing, build an emergency fund with 3-6 months of basic expenses. This gives you peace of mind and protects your investments from being sold too early. Constantly watching the market can drive you crazy. Prices move every day, and daily fluctuations don't matter much in the long run. Beginners who check their portfolio too often are more likely to panic and make emotional decisions. How to avoid it? If you're investing long-term, you don't need to check prices daily. Once a week or even once a month is more than enough. Focus on your life, not the daily noise. Many beginners invest once and then stop. Others invest only when the market feels safe. The problem is, inconsistent investing leads to inconsistent results. How to avoid it? Use dollar cost averaging, investing a fixed amount regularly, no matter what the market is doing. This removes emotion and builds discipline over time. Every investor experiences losses. Beginners often think, maybe investing isn't for me, and quit after a bad year. But quitting early is one of the most expensive mistakes you can make. how to avoid it. Understand that setbacks are normal. The stock market rewards patience, learn from mistakes, adjust your strategy, and keep going. If you're new to the stock market, you don't need to be perfect, you just need to avoid the biggest mistakes. Start small, stay consistent, think long term, and remember every successful investor was once a beginner just like you. If you found this helpful, hit the like button, subscribe for more beginner friendly investing content, and comment below what's the biggest investing mistake you're trying to avoid. See you in the next video.